welcome to Team Chester's final team presentation in DBA 8365, Business Strategy, Simulation, and Integration. Today, we'll discuss our strategy and capstone, or the capstone simulation, for Dr. Don Benitez. This class is in fall of 2024. I would just want to take a second and introduce my team members. Cynthia Silva led our production and capacity. Douglas Silva, he served as our CEO and led our finance efforts. Elizabeth Castro served as our HR and TQM. She was also the team secretary. Myself, Hector Pineda, led efforts in R&D and marketing. The team's overall strategy, our competitive differentiation, the strategy, and it was a way to create superior value. We did this in several different phases and move focus to high value segments. Our target segments were used to maximize growth and create profits, moving away from price sensitive markets like low end and traditional, who would not yield the same results. We emphasized innovation and quality, invested heavily into R&D to deliver cutting edge products with superior performance and features. Premium pricing and customer-centric marketing maintained high margins through premium pricing while driving customer satisfaction and strong product accessibility. In other words, we gave the customer what they want at the prices that they needed. Niche differentiation focused on high growth and high margin segments, high-end performance and size. Technological leadership, we prioritize R&D to deliver innovative and superior products aligned with customer needs. Bigger and better, or smaller and better, whatever the customer needed at the price that they wanted. The premium pricing model avoided price-sensitive markets to maintain high contribution margins. We focus on quality over quantity at a good price. We created superior value, customer-centric approach delivered cutting-edge, high-quality products tailored to specific market demands. Sustainability commitment, integrated eco-conscious practices into product design and operations. Innovative-driven growth, continuously enhanced product performance and customer satisfaction through enhanced technologies. Team Chester's vision and mission. A vision and a mission are two different things that corporations and firms use to drive a few different things. First, our vision is to lead sensor technology industry by creating innovative, high-quality products that seamlessly integrate into everyday life, empower industries and individuals to interact with the world in smarter, more efficient ways. We are committed to meeting the evolving needs of our customers through continuous improvement, affordability, and cutting-edge solutions, all while maintaining a steadfast focus on sustainability, corporate responsibility, and enhancing the communities we serve. Aspires to leadership in innovation and quality, promotes corporate responsibility and sustainability, focuses on customer-centric technological solutions. Our mission, premium products for technology-oriented customers. Our brands define the cutting edge. Our primary stakeholders are customers, stockholders, management, and employees. Targets technology-focused customers, maintains a premium market position, and emphasizes high-quality, innovative products. Both our vision and our mission target a market where we can succeed and also yields good results for the team as a whole. I'll turn it over to Douglas.
Great, thank you, Hector. Now I'd like to speak about the industry competitive forces, and more specifically, I'd like to tie Porter's 5 forces into our simulation and the individual forces that applied to Team Chester. First, I'd like to talk about the suppliers. Moderate power. Chester's leveraged supplier relationships with shorter than normal accounts payable days to maintain consistent input costs and avoid disruptions despite industry constraints. The simulation automatically defaults to 30 days for accounts payable and accounts receivables. We were able to leverage these, although it would strain our cash flow. By being disciplined and moderate, we were able to tie in our accounts payable a little bit shorter than 30 days progressively as the simulation went on to ensure that Our suppliers were providing us with quick turnaround time so that we didn't have any delays despite all the industry constraints. Our second one would be buyers. The buyers, of course, had high power. As Hector said, they were the ones that dictated the market. The customers demanded premium, innovative products. Chester responded by differentiating through advanced research and development and superior product quality. It took a pretty large investment, especially in round 2 for us, through research and development, to make sure that we are able to scale up and provide the customer demand. Since they did demand the premium and innovative products, that production, the marketing, and the capacity all took into account a lot of investment. And that's what tied up cash flow initially, but we were able to reap the rewards once we maintained our market share. Number 3, new entrants. This was a low threat. The high research and development costs and established market players created significant barriers, allowing Chester to maintain its competitive edge. Andrews was the first team that we saw have a new entrant into the simulation. Although we did discuss briefly the potential of having a new entrant, we decided that this, with the high research and development costs and the need for superior product quality, was not in the best interest for the team. Number 4, substitutes. This was a moderate threat. Substitutes posed a risk in low-end markets. Chester focused on premium segments where substitution was less viable. As Hector mentioned, initially, we set out with a strategy to focus on low-end and traditional markets. Once we saw how the market built itself based on the demand for premium innovative products, we saw that there was a lot more profit margin in the other areas opposed to low-end and traditional. The high-end, size, premium markets were the ones where there was a higher contribution margin, and therefore the focus to potential to grow with our market share that we had already established. Number 5, competitive rivalry. This was intense. All 6 teams started in the same position, but Chester operated in a highly competitive market, but strategic positioning in niche markets minimized direct price wars. Through our focus on market share, we were able to essentially bully out other teams by saturating the market, ensuring that our costs were on point, taking into account what the customers demanded, and then moving into different segments to spread our market share. Next, I'd like to talk about our generic strategy, our differentiation focus. So our strategy type. Chester shifted to pursue a differentiation strategy within high growth, high volume segments, the high end, the performance, and the size. This was a shift in round 2 from low end and traditional to ensure that our market share was appropriate where it needed to be and we could saturate it accordingly. We emphasized superior product design, innovation, and premium pricing to attract technology-focused customers. This was through our research and development. And so that tied in our marketing and then, of course, our capacity. The organizational changes implemented. We increased investment in research and development to ensure products met evolving customer preferences. We let the customers dictate the market. Then we enhanced marketing efforts to build brand loyalty and increase product awareness. Our product awareness and our customer accessibility were huge pieces to us. We invested a lot of money, not only in that, but of course in also research and development. We wanted to ensure that our market share had the best chance at saturating the market. Then we streamlined production and supply chain processes to align with premium product standards. Now we can look at strategy effectiveness and evaluating our strategy success. For our sales and growth trends, we had consistent growth in revenue and market share in all segments. We took pride in doubling overall market share from the start of the simulation to round 7. Of course, we had all 6 teams starting at the same round with the same market share, with 16.67% of their market share. After round 7, we were at 33.3%, which we took pride in as that was one of our goals. We increased customer satisfaction scores, especially in the high-end and performance segments, where we turned most of our attention to after leaving their concentration of the low-end and traditional. Our financial strength. We delivered above average contribution margins in our targeted markets, which was huge so that we could be productive, yet efficient, and run lean. We improved cash flow management and reduced operational inefficiencies by making an upfront investment in round 2. Reputation and internal improvements. We strengthened our brand image as a premium provider of high-tech solutions, saturating the market and doubling our market share. And of course, our internal KPIs showed reduced delivery times, higher employee productivity rates, and improved order processing metrics. This through our investment in our human resources and our total quality management TQM. And then, of course, our effectiveness through our supporting data. Throughout round 3 through round 8, we were first in stock price, finishing the simulation with the highest stock price of $408.49, a growth of over 1,000%. As I mentioned, we doubled our market share going into round 8 at 33.3% from our initial 16.67 where all of the companies started. And of course, with our high stock price and our management of our shares, we were first in market cap at $805 million and a book value of $183.65. Looking at our SWOT analysis and breaking down our strengths, weaknesses, opportunities, and threats, there were a number of different items that popped up for each section. Our strengths: strong research and development capabilities, driving innovative product design. As mentioned, and will be a recurring theme throughout this presentation, is our investment in R&D. Our investment in not necessarily trying to force a higher stock price through dividends or buybacks, or even having lack of discipline in releasing more shares or buying bonds. We invested in ourselves at research and development, and that drove our innovative product design. With that, we got high customer loyalty in premium market segments that had the highest yield. We had effective differentiation strategy leading to superior brand recognition, which was present in our market share doubling to 33.3%. Some weaknesses: we did have higher production costs due to our premium focus. With that and tapping into that market, as mentioned, we had a big investment into research and development, human resources, TQM, and accessibility and awareness. There was limited presence in low-cost market segments once we made that shift from low-end and traditional. There was also dependency on niche markets that may reduce our scalability, but through saturating the market, we were able to be just fine, and that scaling took place naturally with improvement in stock price and market share throughout the course. Our opportunities: the growing demand in high-end and performance segments, which we were able to tap into. Our expansion into untapped global markets, what we took into account moving into round 3. And then, of course, our technological advancements enabling our cost efficiencies. This helped our production and our bottom line. The threats: intense competition from market leaders in performance and size segments. There were a few companies that would pop up that showed the potential of threat of maintaining and managing a market that we were trying to get into. We stayed resilient, focused on market share, delivered what the customers needed, and we were able to capture that market. Another threat would be rising raw material costs impacting profit margins. By keeping our accounts payable low, we were able to ensure that our suppliers were paid quickly and we had no holdups despite this competition and our rising material costs. And then potential market saturation in premium categories. I believe moving into round 8, this may have happened. There was a slight decrease in market share to 29%. But I believe that that was something that had to take place. And if the simulation were to continue, we would see ourselves bounce back and improve once more. And now, Cynthia with our resources and capabilities.
Thank you, Douglas. In this slide, we're going to take a close look at Chester's key resources and capabilities and how they align with our strategic goals. These have been what drive our success and competitive edge. First, let's talk about our tangible resources. They are truly the strength behind our operations. For example, financial strength. Chester earned a cumulative profit exceeding $348,000 and retained earnings of $344,314, showing our financial stability. On top of that, our stock price of $408.49 is the highest in the industry. Our physical assets, we've invested over $242,000 in plant and equipment to make sure we can meet production needs now and in the future. When it comes to our production efficiency, we have a contribution margin of 39.29%, which means we're operating efficiently. Plus, our TQM initiatives reduced material costs by 11.8%. This helped to improve profitability without sacrificing quality. In our next slide, we're going to take a moment to discuss Chester's intangible resources. These resources truly set us apart from the rest. Our market position. Chester holds the highest total market share at 29%. We dominate key segments with a 36.4% share in high-end and 31.6% in performance. As for brand equity and innovation, our products are personalized to meet our customers' preferences. This is due to our strong R&D and innovation efforts. A productivity index of 130% tells just how efficiently we utilize our resources. In our next slide, we're going to show you how all of this aligns extremely well with Chester's differentiation strategy. We invest heavily in R&D and TQM to deliver high-quality products that resonate very well with our customers. We dominate key market segments like high-end and performance, which reinforces our leadership. While focusing on differentiation, we also maintain cost efficiency through material and labor cost savings. We can see that Chester's resources and capabilities are strategically aligned to drive success and sustainable growth. Together, they help us meet and exceed customer and market expectations. In my last slide, let's review Chester's performance measures. Key achievements. When it comes to our financial strength, we delivered a net profit of $84,965 and a cumulative profit exceeding $348,000. These are strong indicators of consistent and sound financial management. Our market leadership. Chester captured the highest overall market share at 29%, leading the high-end segment with 36.4% and the performance segment with 31.6%. When it comes to our operational efficiency, our contribution margin is at 39.29%. This shows that we guaranteed profitability while maintaining premium quality. Our TQM initiatives, by applying total quality management, we cut material costs by 11.8%, increasing cost efficiency. Our productivity index of 130% proves our exceptional workforce and operational efficiency. With all of this, we still acknowledge our missed opportunities. While our performance was strong, we faced some challenges, mostly with capacity. Limited production capacity affected our ability to fully meet market demand. Expanding capacity will be a critical focus for future rounds. Overall, Chester excelled in financial performance, market leadership, and operational efficiency. By tackling our capacity constraints, we'll continue to drive growth and meet stakeholder expectations. Now here's Elizabeth to speak to you about winning performance.
Thank you, Cynthia. So with winning performance, Chester's final results, our final position, Team Chester placed strongly in the game, achieving first with 29% of the market share, leading all competitors. Our financial performance was strong with a cumulative profit of $348,038, well above industry average of $151,581. Chester's stock price also closed at $408.49, indicating high investor confidence. With market share dominance, Chester held the largest market share across segments, outperforming competitors like Andrews and Digby. Profitability, Chester's contribution margin was 39.29% and effective cost controls. Strategic investments. Chester made notable investments in R&D, marketing, production, leading a better alignment with customer needs, especially in key segments like high-end and performance. Productivity. Chester's workforce showed a productivity index of 130%, which was higher than most competitors, reflecting an efficient management of human resources. Financial discipline. Unlike some competitors, Chester avoided emergency loans, reflecting strong financial planning and cash flow management. Chester's success was a combination of strategic investments, effective marketing position, and operational efficiency, which ensured consistent performance throughout the game. Lessons learned. Profitability growth. Chester showed a significant improvement on return on equity from 2.6 in our first round to 23.5 in our last. This reflects better strategic decisions in capital management and operations efficiency. Market leadership. By 2032, Chester captured the highest market at 29%. Inventory management. Challenges in inventory control early on, such as stock out or overstocking, were refined by 2032 by better alignment of production and demand. Financial discipline. Avoiding emergency loans and controlling debt levels were crucial steps in maintaining financial stability, reflecting lessons in disciplined financial management. Customer focus. Strong emphasis on meeting customer needs and enhancing product positions contributed to sustainable market dominance. These lessons highlighted Chester's strategic transformation from a modest performer in 2025 to a market leader by 2032.
Thank you so much, Elizabeth. Thank you. So on behalf of Team Chester, thank you for, listening to our presentation, our victories, and also our opportunities for improvement. I think I can speak on behalf of the group and say that this was a fantastic opportunity to be able to enter the simulation together, to grow not only as a group, but also individually academically. We took our first 2 rounds very seriously, and I believe that our results reflect our strategies and our ability to adapt. So with all that said, thank you.